El estratega Luca Paolini. Luca, muy buenas. Muchísimas gracias por brindarnos unos minutos. Luca, no te estamos escuchando. No sé si tenemos algún problema con el sonido.
Can you hear me?
Yes. Thank you so much, Luca. Thank you for having us a few minutes in Negocios. We will see 6 lessons of investment with you, with Pictet Asset Management. One of them is about inflation. We have seen how inflation has a negative impact in all financing assets. How do you see that in Pictet?
Well, it is very simple at the end of the day. When you have an increase in inflation similar to what we have seen last year, what happens is the following. Inflation is a tax on the consumers. The consumers spend less, so the economy gets weaker. And that's obviously negative for equities. At the same time, if inflation goes up that much, central banks need to react. So basically what happens? Interest rates are going up, and if you're a bondholders, you lose money. So in fact, inflation is a tax on the consumer, it's also a tax on investors, and very few asset classes managed to end in positive territory last year. And one was Chinese bonds, for example, because China is in a completely different macroeconomic environment. But inflation has proved to be what the textbook would have told you, always a problem, is never a solution. That's one of maybe the biggest lesson that we as investors have learned in 2022.
Another of these lessons is about central banks. How do they not want confidence risk?
Well, they made, and I would say almost all central banks, they made an horrendous mistake of downplaying the risk of inflation. And then they have to effectively correct a mistake, potentially with another mistake. So they went from being incredibly optimistic about inflation to a situation now where they panic about inflation. They're forced to hike interest rates to level where probably will trigger a recession. So US went from 0 to more than 5. The ECB will probably hike rates to 3.5. These are levels in interest rates that are well above what probably this economy can absorb. So I think it's important to understand that when, as a central bank, you make a mistake, your credibility is at risk, and you tend to overreact. And we are basically paying the price now with very low growth and potentially a recession, or very mild recession, whatever you want to call it, maybe just because central banks need to regain the inflation credibility they've lost with some of kind of comments. You remember, inflation is transitory, don't worry. And actually there were a lot of reason to worry, and now we know.
Another lesson that gave us 2022 for Pictet Asset Management is how economies adapted surprisingly well with every shock that we saw. Do you think this will continue this year?
Well, I think maybe it's our nature as human beings, so that's the way we are. I don't know. But the reality, we always tend to see the negative side of things. And of course, the war in Ukraine is horrendous for the human costs and also obviously for the sufferings that it brings. But when you look at for example, the spike in energy prices, if you look at the spike, well, in oil and natural gas, but even if you think about wheat prices, so food prices, they were obviously the consequence of the invasion of Ukraine by Russia. Well, you look at the prices now, we're already below the level of a year ago. What it means is this, that economies adjust. I can give you one simple numbers. German GDP is higher than it was a year ago. Industrial production is higher, but the consumption of gas is more than 10% below. It means that, in a way, we as human beings, but also economies, adjust to a new reality, maybe better than we thought would be possible. So what was looking like an obvious recession, an inevitable recession, is becoming something much less dramatic. Again, sometimes you have to be proud of what we have done. And I think in Europe also we have been very good in trying to conserve and save on energy, obviously because we are forced by higher prices. And again, never underestimate the ability of economies and also in a way investors to adjust to a new reality, which is more difficult than before, but is still manageable.
Another of these lessons is how regional effects and currencies matter. and which analysis must we do now?
Well, we tended to see for many years currency as a side story of our investment. As an investor, you can invest obviously in your own currency, so currency do not really matter. But actually, we are in a global market. And if you think about how strong the dollar was last year, well, if you're invested in dollar assets, you could almost offset the losses that you had on holding, a specific bond or a stock in local currency. So it's very important to highlight that, especially when the total returns are low, things that normally are not we don't pay too much attention, like dividends, for example, or currencies become much more important. And if that's the case, currencies tend to be driven by basically a few things: central banks, the economy, but also some long-term factors, productivity, the ability to generate a current account surplus, for example. So I think currencies will become, going forward, one of the key elements investors should look at in order to allocate their money in a very efficient way.
We know that Chinese assets should be considered separately from emerging and developed markets. How must we see China in a year when we are seeing how zero COVID policy is going behind?
Look, China accounts for almost 40% of that changes day by day, roughly 40% or a third of emerging market equities. For example, if you look at the MSCI benchmark, China is the second biggest economy in the world, $20 trillion. So it's a huge market. And for that reason, but also for political, macroeconomic, but also COVID-related reasons, China's been moving in a way that was not correlated with the rest of the world, right? And you see that in markets. So China at some point was trading almost at the same multiples, so the same valuation of the rest of the world in 2021. A few months ago, Chinese equities were trading at 50% discount, and now it's 30%. Why? Because there has been, I think, a mismanagement in terms of COVID. There has been a significant deterioration in the business climate because of regulation, and there has been also the sanction applied by the US on China. So China is a different market. It's so big that it has to be, in our view, considered separately from the rest of EM. And the rest of EM, it's India, so a growth story, which we like, Latin America, which is very commodity-oriented. So in our view, that's one of the lessons. China, for its size and its characteristics, must be treated separately. And we believe that this year China will continue to do well because the reopening of the economy is happening. The Chinese consumer are spending, and valuation is quite attractive. So we think that this is the time to look at China in a more positive way.
And finally, how do you see market right now? Can we say each year market involves new ways of losing money?
Look, I would love to be optimistic and being able to tell you that everything is great. The reality, though, is that you've seen just a few hours ago, the inflation report of the US. Inflation continued to be high, much higher than we all want. Global growth is basically zero. If you look at the US or Europe, there is no real growth. Valuation of equities, but also bonds, is at best neutral. So I think it's difficult to be very optimistic. I think that what we were expecting for the entire 2023 has already happened. So I think is from now on, the direction of inflation and growth will be critical. And I'm afraid that inflation will probably fall, but not as much as investors hope, and growth will still disappoint. So I think it will be difficult for equities to do very well for the next 6 to 12 months. And we think the value is in emerging markets, in some bonds, especially in the US, but it's going to be much more difficult in the next 6 months than it has been in the last few weeks.
Luca Paolini from Pictet Asset Management, thank you so much. A pleasure.
Thank you. Thank you. Have a good day.